Good evening, my name is Matt Dillon, and tonight I will be going over the financial statement analysis for 3M. 3M's overall cash increased from $1.85 billion to $3.04 billion from 2008 to 2009. This was an increase of 64%. Assuming that there is not an equivalent increase in current liabilities, 3M's cash increase will improve its current ratio. This ratio measures whether a firm can pay its maturing debt obligations. The current ratio is important to both investors and shareholders alike, since it reveals if a company has the cash on hand to meet its obligations, if the company needs to borrow money, or if the company is headed for bankruptcy. 3M values its inventory at the lower of cost or market. More often than not, the company will value inventory based on historical price. However, when the carrying value falls lower than the market value, that carrying value will be recorded on the books. 3M's total common equity, which is made up of common stock, retained earnings, and additional paid-in capital, increased from 2008 to 2009 by 29%. Conversely, its operating income decreased from $5.2 billion to $4.8 billion. This shows that, despite a drop in sales, 3M was able to improve its net worth by selling off more shares of common stock. Net income available to stockholders has been steadily increasing from 2003 to 2007. However, it began to decline in 2008, right around the time of the global financial crisis. The P/E ratio for 3M at the end of 2009 was 18.29. This was calculated by dividing the ending stock price by the diluted earnings per share. A company's P/E ratio reflects the level of optimism generated by the market regarding the company's future growth prospects. The PEG ratio at the end of 2009 was minus 2.42. The PEG ratio offers investors a glimpse of how well a company is doing based on past earnings and future projected earnings. As you might imagine, 3M's PEG ratio of negative 2.42 is not a desirable figure, but it accurately reflects the uncertainty of future growth during that time. 3M's current stock scouter rating is a solid 7 out of 10. Looking past 2013, we can see that analysts expect 3M to outperform the S&P 500 by more than 3 percentage points. They also expect the earnings growth rate of 3M to perform very similarly to that of the industry over the next 5 years. Over the past 4 years, cash from operating activities has trended positively, mirroring the increase in net income during those years. Cash from investing activities has stayed consistent. 3M has made an effort to reinvest in the company by making consistent purchases in property, plant, and equipment. Cash from financing activities has also stayed consistent, excluding the year 2011. This year saw a major repurchase in stock, which resulted in a negative free cash flow.